This is the Savvy Investor radio show and podcast with Mike Kinnett and Ryan Herbert of ProStatus Financial, now celebrating 20 years helping families build successful retirements and lasting family legacies. Mike is a financial planner and estate planning attorney with a master's degree in tax and 4-time Amazon best-selling author. Ryan is a 5-star Wealth Management Award winner and top-ranked financial advisor by Forbes. Now, the Savvy Investor radio show and podcast.
What should you do when the market pulls back and you're close to or already in retirement? Well, that's a big question that a lot of people are asking lately. And that's why Mike and Ryan are here to help you grow, keep, and distribute your wealth in the most tax-efficient manner possible. Ryan Herbert's been, anytime the market goes down, people start to panic. We're going to get into all that. How have things been in the last couple of days at ProStatus? Are you guys getting a lot of calls about the market going up and down and just the gyrations and the volatility?
No, it's not really a big thing, for us here at ProStatus, for our clients. We don't really get a ton of phone calls about, the stock market being down. On Monday, it was down 2.5%. 3%. And then Tuesday, it started to come back. Whenever we have these large gyrations in the market, we never really get a ton of phone calls. There might be one or two clients where it prompts some other question to come forward, but there's never really anything that goes on. Clients calling us in a panic, asking us what we're doing, simply because Mike and I and Catherine and Lawrence and Andrew and our team here at ProStatus, we have always tried to be very telegraphic, very communicative about what we think is going on in the market. And more importantly, we design retirement plans. We design income streams that are set up in a way that you have the income that you need coming in every single month, regardless of what's going in the market. We set it up in a way that, if you're saying that January 1, 2025 is my retirement date, nothing that happens in the market is going to impact that retirement date. And that really is the importance of having a true financial plan, is having a plan for these gyrations in the market, because it's normal and these things happen all the time.
And that's the key. And we just jumped right into it here here on the show and the podcast, because that's what we've been seeing all week. And a lot of people are concerned. This is going to happen. It's always going to happen. But if you're close to retirement or if you're in retirement, it can hurt a lot more. I mean, no one wants to lose money, but some are blaming it on Japan, the banking system, the job reports, even Mercury retrograde. Do you believe in astrology? Okay, you don't have to answer that.
I mean, hey, the moon's in a waning crescent phase, and the tide is halfway retreating. I don't know, something like that.
So the market's going to go up and down for whatever reason, but when the bear bites, it's the in-between. It's when it's down that hurts. So, Ryan, what do we do? I mean, you guys always talk about a plan for retirement. Can we have protection, growth, and income? Can we have the best of both worlds so we don't have to worry about what's in the headlines?
Having your cake and eating it too. That's kind of the way that Mike and I like to describe the financial plans to our clients and our prospective clients. And, like you said, some people blame Japan. Some people blame the central banking systems, the weak jobs report, where, the jobs report 1 week is very strong and the market goes down. And then the next week it's weak and the market goes up. The banking system, the Fed, the Federal Reserve has said we are going to start lowering interest rates at some point. Now we are, probably more than likely at that point. It's the same thing when they said we are going to raise interest rates. When they finally started raising interest rates, people started freaking out because interest rates are going to go up, mortgage rates are going to go up, credit card, all the interest that I pay is going to go up. Well, it's not as if this is something that is unexpected. They've been very telegraphic about doing it. And, as I mentioned, Mike and I are always very telegraphic, communicative about how we are working with the portfolios, how we're working with our financial planning clients. Every quarter, I try to do it the first Tuesday of every quarter, but it doesn't always work out like that. But every quarter, Mike and the team and myself, we do a economic update for all of our clients, and even for our radio listeners and our prospective clients. If you're on one of our mailing list or our contact list, you'll get this invite to this webinar. And what I was talking about in the webinar is here's what's going to happen when the Federal Reserve starts raising interest rates. Not only that, we have a debt ceiling issue coming up in September of this year. There have been, I think, 10 members of Congress who have said that they are not going to raise the debt ceiling. They will shut down the U.S. government. They shut down the U.S. government. That's going to cause the markets to just absolutely crater. And so what Mike and myself and the team here, what we've been telling our clients is in August, we are going to become defensive. At some point in August, we are going to move everything over to cash or cash alternatives or extremely defensive positions, because if I'm right, if Mike and myself and our team, if we're right, and they do have debt ceiling issues come in September, well, the stock market's probably going to drop 5 to 10%. So if I'm right and we move everything to cash, we avoid that. If I'm wrong and the stock market, doesn't do that, we don't have a debt ceiling issue, they pass it and they kick it down the road like they always do, well, we might miss 2 to 3% on the upside. But we are very telegraphic, we're very communicative with our clients about what's going to happen. And so when I'm having these conversations with clients, I always bring up the fact, did you listen to the webinar? Well, if you did, you know what I'm talking about. But if you didn't, here's what's going to happen in the portfolios. We are very, very proactive in that nature. You're not going to have those conversations where you have the stock market crash like you did in 2008, like you did in 2015, like you did in 2020, like you did in 2022, where you call your advisor up and ask them, what are we doing? What should I be doing? And the response is, just hold on. The stock market comes back. It always does. Or, it's only a paper loss until you sell. Well, those are not the conversations that Mike and our team and myself that we have with our clients. It's a very different conversation where, yes, the stock market is down. Yes, we have made moves in the market. Yes, we are monitoring everything, but most importantly, your retirement is on track. Your retirement plan has built-in measures that help protect us against the ups and downs of the market, so that when the stock market is up, you can participate in the upside of the stock market. When the stock market is down, we are really trying to eliminate the downside. Now, we don't eliminate it altogether. It's not the stock market goes up, you make money, and the stock market goes down, you never lose anything, because that's not really how things work. But as much as we can protect you on the downside, that's what we are doing. And if you are not having this type of conversation with your advisor, where he's talking to you about here's exactly what's going on in the markets, here's exactly what we're doing, and it's more that, hold on, the stock market comes back, it always will. Or, you're doing this yourself and your emotions are starting to run you ragged and you're just not sure what you should do. I encourage you to just click the link in the description below and sign up for your own complimentary retirement plan that's going to talk about here's what we do in these wild gyrations in the stock market. So just click the link in the description below and don't forget to like and subscribe to the channel.
Ryan, you mentioned emotions, and emotions have got to play a very big role in all of this, because they do for me. When I saw the Fox Business headline, it said after the worst sell-off since 2022. So I'm panicking, thinking of, hey, what's going to happen? And I'm sure the sentiment is equal to our listeners right now. But then the next day it's back up. Those gyrations, how much does emotion play into this? But specifically when there is a plan, when you have it in black and white there, when you have it written down, does that help minimize the emotions when the market pulls back, when the bear bites, if you would?
I like to think that it does. The judging from the reaction or non-reaction, if you want to call that, from all of our clients, the non-reaction being that we don't get a ton of panicked phone calls when things like this happen, when we have these wild gyrations in the market. I mean, yes, the emotional aspect is there. It's uncomfortable. No one likes losing money. No one likes seeing their portfolio drop 5 or 10% or, whatever the number is. I don't like it. I own, a bunch of NVIDIA stock. I own a bunch of that in my daughter's college accounts that were saving money for their education and if they don't go to college, weddings or whatever they want to use the money for. And the price of that the other day went from $110 a share down to like $97 a share, and then you turn around the next day, it's right back up to 108. So there are those people that take emotion and they act on it right away. I'm going to sell everything. I got to get out. I want to stop the bleeding. But then, you turn around the very next day and, had you not sold, you'd be right back kind of to where you started. But, the beautiful thing about having a plan, the beautiful thing about having, a financial advisor who's telling you what's going on and communicating their actions to you, I really think, it's never going to erase the emotion altogether. It's never going to make you not panic or be concerned about what's going on in the market. But it really takes some of that weight, that emotional weight off your shoulders of knowing that my retirement is secure. And, it for our clients, sometimes we get phone calls. One of our clients called on, it was Monday around like 5 o'clock. And I heard one of my staff members, I heard Brian talking to them. And, Brian sits down the hall for me. And if he's loud enough on the phone and if he has him on speakerphone, I can hear what's going on. And I do, if I'm not, really doing anything, I do like to listen just to see what he's saying. And, he was on the phone for about 25 minutes, talking to the client about here's what's going on. And then at the end of the call, he hung up and I asked him what's going on. He goes, oh, well, Sue called and, she noticed that the portfolios are down, about 1.5%, so far for the day. And he was kind of talking about the day fluctuations. And then I said, okay, what she want to talk about? She goes, well, so actually, she wants to do a Roth conversion and she wants to do it right now because, her accounts are down 1.5%. If we convert that money, when the market turns back around again, she's converted, the same amount of shares at a lower dollar amount. So less taxes. That way, when it rebounds, she has all of that earnings is now tax free. And so really, the bottom line to that is having that emotional factor taken away really leads to other conversations of being that are being had. So, Sue called in and said, hey, my accounts are down 1.5% today. I'm okay with that. I know you guys are watching it, but let's take this advantage right now. Let's do this Roth conversion, first thing tomorrow morning and get it done. That way I'm helping save myself even more money on taxes. That does kind of come into a market timing aspect, but that's really having that emotional disconnect, I would say, opens you up to these other processes of thought. And that's kind of what I said, where the conversations that we have in times like this are not always about the market. It's about, all right, here's what's happening. What can we do?
Yeah.
Take advantage of what's going on? And if this is not a conversation that you're having with your significant other, that you're, thinking about yourself, or that you're having with your financial advisor, I encourage you to click the link in the description below to schedule your 15-minute consultation about a complimentary retirement plan that takes the emotion out of retirement planning and puts you back in control. So click the link in the description below to schedule your meeting, and don't forget to like and subscribe to the channel.
So there are a lot of studies out there when it comes to financial planning, and given the last couple of days here where the market was volatile, those things just start coming out even more and more. There's a new study here from Global Atlantic, Ryan, that I want to run by you, and that is a leading U.S. retirement and life insurance company. They say that the responses said that 61% of retirees would rather preserve their money than grow it. So it seems like they don't want to lose their money. I can agree to that. The study also found 65% wanted to guarantee their income for life, and 69% reported discussing loss prevention with their advisor. Does the fear of losing money work against people to the point that they can't grow that enough? Can we have the best of both worlds there? I mean, I want to preserve my money, but I also want to grow it.
Mm-hmm. It really is kind of one of those double-edged swords. It's, I want to have my cake and I want to eat it too. I want to protect my money. And then, I also want to be able to grow my money. And that really kind of is where the insurance industry does step in. This is kind of where annuities tend to get a bad rap, because what a lot of advisors, and I'm using air quotes on radio, what a lot of advisors say, when they're actually insurance agents is, you can put your money into this annuity. It says stock market goes up, you go up with the stock market, never mind the fact that maybe it's capping you or they're giving you 30% or 40% or some multiplier, some type of calculation done on the stock market. But in exchange for that, you never lose any money. And people think, oh, well, that's great. I make money when the stock market goes up, and when the stock market goes down, they guarantee that I'm never going to lose anything. Well, the downside of that is all of your money, whatever you put into that, is tied up for 7, 10, even 15 years. And if you want to get your money out, they limit how much you can get out, normally 10%. And if you take out more than that, they charge you a big penalty. So that's what annuity companies do. That's what insurance salesmen do. That's what they're telling you. That's what the promise is. In exchange for those guarantees of having guaranteed income, or in exchange for the guarantee that you're never going to lose anything, you're giving up liquidity and you are giving up some of that growth potential. So when, you're thinking about how can I protect and preserve my money and yet still grow and get income? Yes, annuities can be a viable tool. But, it really just is one of those things that you put in just enough money to accomplish the goal. Whenever we talk about using annuities with clients and we're talking about using it for income, we're always trying to figure out a specific dollar amount. I have my Social Security coming in that's $3,000 a month. I want to be able to spend $5,000 a month. So all that we're doing is we're putting enough money into an annuity, if that's appropriate at the time, to generate that extra $2,000 a month to give them that $5,000 a month number they're looking for. It doesn't make any sense to fill the gap. Okay. Because it doesn't make any sense to put any more money into it than you need to get the money out, because all you're doing is just tying up the rest of your money. And whether you're using annuities, whether you're using preferred stocks that pay set dividend rates, whether you're using the general stock market and blue chip stocks like UPS or Microsoft or McDonald's or any of the oil companies that pay steady dividends, in any of those strategies, you always want to put just enough money in them to get the income out for what you need. What people want, like Global Atlantic said, is, Global Atlantic is an insurance company. They are an annuity company. They sell annuities. They want income. Well, you can use one of those three options to generate income in retirement. They all have their pros and cons, but you only put in just enough money to accomplish the goal. That way you are preserving your income in retirement. You're protecting your income in retirement by setting up an income stream for yourself in retirement. And then everything else that you're not setting aside for retirement. Just this past week, I was having a conversation with one of my clients in the Towson office, and he was talking about, he's a little bit over 60 years old. The plan for him is to retire at 65, to stop working at 65. And he was saying to me, I'm getting tired. I'm getting stressed. I don't think I want to continue working at the pace I'm working. I want to take, I still want to work because I like doing it. I just don't want as much stress. If I take a reduction in hours, I'm going to take a 20% hit to my income. What is that going to do for my retirement plan? And what we had walked through previously was we set him up for retirement using this strategy of just setting aside enough money. So altogether, he has about $2.3 million of retirement assets. A number of years ago, when he came in, he heard us on the radio. He came into my office in Towson. We sat down and created this retirement plan. We took about $200,000 of his money and set it aside for income, so that between his Social Security and the investments that we used is going to generate the $60,000 a year that he needs for retirement. So of his $2.3 million, we used $200,000 to generate the income that he needs in retirement. So all the extra $2.1 million that he has, that's his extra money in retirement. I'm sitting down, we're walking through the numbers saying, based on the plan that we had set up, the plan that we designed for you, that you agreed with and that we put in place, no matter what happens at age 65, you have, I think it's like $5,000 a month coming in every single month. It doesn't matter if you're making 20% less and you're setting aside less money for retirement over these next 4 years, because no matter what happens, you have the income that you need. Essentially, all this extra money that you're saving is going to go to your kids. So if leaving a larger legacy than $2.1 million adjusted for inflation is important to you, leaving that to the kids, well, then probably you should keep working at the same pace you're working. But if the stress of this is killing you, I hate working as much as I do, it's causing me all kinds of other issues, it's okay to slow down because it's not going to impact your retirement. And whether we're having conversations about working in retirement, whether we're having conversations about I want to retire early, or whether we're having conversations about the ups and downs of the market, if you take those steps to make sure that no matter what happens, you put a plan in place, a solid retirement plan in place that says no matter what happens in the economy, with my job, in the stock market, as long as the world doesn't go to hell in a handbasket and we're all surviving on guns, toilet paper, and ammunition, your retirement is secure. You're going to have the retirement that you want. That is the beautiful thing about working with financial planners like Mike and myself. And if these are conversations you've been thinking about, you've been having with your significant other, and you haven't been having them with your financial advisor, I encourage you to click the link in the description below to set up your 15-minute call for your personalized complimentary financial plan with Mike, myself, and our team here at ProStatus. So just click the link in the description below, and don't forget to like and subscribe to our channel.
When you put the plans together, do you tell your clients, hey, easy on the news now, you're good to go, don't get stressed out about that?
It really, that's the further conversation that happens when, times like this come up. If they, if they're newer clients and they're new to the process, maybe I get like 1 or 2 phone calls, but that's, we have taken the time to set up a plan. All these headlines don't mean anything. They are headlines just to grab your attention. This past week, Mike, he's texting myself and he's texting, a few of our staff members that are involved on the investment sides. What's going on in the stock market? And I said, nothing. I can go on Yahoo and say, here's what the headline says. The headline says the Fed's gonna start cutting interest rates. Well, that's what we know. The headlines really are dictating what's going on in the stock market by getting people to click on it, by getting people to feed into their emotions and make those emotional decisions. The wonderful part about having a true financial plan is knowing that the emotional side of it can be taken out of the equation because you have a plan that accounts for those ups and downs of the stock market, those wild gyrations that we can see at any time during the year.
So we got the protection taken care of. We got the growth and the income taken care of, and the baseline is always taxes. We always talk about taxes here on the Savvy Investor Radio Show and podcast and YouTube because at ProStatus, taxes are the foundation. Help grow, keep, and distribute your wealth in the most tax-efficient manner possible. This is also a big component. I just want to touch on this for just a second. For those listening now thinking, hey, I got this great plan, but what about taxes? Taxes are also a huge part in these plans that you guys put together.
Yeah, I mean, it's, if by doing nothing, you stand to lose 20 to 30% of your money to taxes alone. Forget about the gyration.
Forget about the market.
Forget about 2008. Forget about 2000. Forget about 2022 or 2020 or whatever, economic downturn or stock market drop you want to think about where you lost 10, 20, 30% of your money. By doing nothing, by not having a plan in place, you are going to lose 20 to 30% of your money right off the top to taxes. That's why tax planning is such an important part of financial planning. It's why we have these conversations with our clients about Roth conversions. Here's what's going to happen by putting a tax plan in place. Now, not everybody wants to do it. It's not right for everybody. It doesn't make sense for everybody. Some people have this emotional, visceral reaction to me saying, okay, by doing nothing right now, by using your income, your tax return, you're going to pay $37,000 in taxes, which is what you've been paying, all these years. But I want to put a Roth conversion plan in place, and I'm going to take that $37,000 in taxes. I'm going to make it 80. People are like, well, why am I going to pay more money in taxes now if the whole point is saving money in taxes? This is the step. This is the process of making sure that in the future, when tax rates go up, all of the money that the government could potentially tax, the trillions upon trillions of dollars that us as Americans have inside of our 401ks, our IRAs, our TSPs, our 457s, is the perfect place for the government to start taxing us further. If we get all that money over into Roth IRAs now, it doesn't matter what they do with tax rates in the future because that money is now tax-free. You cannot tax $0 dollars in those accounts. Having that tax plan is a huge part of a true retirement plan. And if you're not having the conversations with your financial advisor, if you're not having the conversations with your CPA because your financial advisor has told you, go talk to Tom, my CPA, he handles all my tax stuff. If these are not conversations you're having with your advice givers, I encourage you to click the link in the description below to schedule your own personal retirement plan consultation where you're going to sit down with Mike, myself, and our team here at ProStatus. So just click the link in the description below and don't forget to like and subscribe to our channel.
Well, Ryan, thanks again for your time, as always, helping us navigate through the tough times of the market, taxes. But it's good to know that you, Mike Kinnett, Lawrence, and Catherine, and the entire team at ProStatus are here to help us navigate to and through retirement, because you guys take care of everything in retirement at ProStatus. As always, though, you get the final word.
This is Ryan Herbert. Thanks for listening to the Savvy Investor radio and podcast. We will see you, the Savvy Investor, next week.
Advisory services offered through ProStatus Financial Advisors Group, a registered investment advisor. Insurance licensed in Maryland. ProStatus Financial Advisors Group, LLC is not licensed in all 50 states. To find out if ProStatus Financial Advisors Group is licensed in your state, please call 410-863-1040. ProStatus Group, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through representatives of ProStatus Financial Advisors Group.